Well, welcome back to the Decarb Connect podcast. And I'm really pleased to be joined today by Irena Spazzapan from Systemiq Capital, where she is the managing partner. We're going to be talking about Systemiq Capital's approach to climate tech investment, a little about their portfolio and, different perspective maybe on industrial decarbonisation than we've had in some of the recent episodes. So Irena, could I ask you, as a lazy podcast host, can I ask you as my guest, just to give a bit of background on you, like how have you arrived at this point in time where you are working at Systemiq and involved in this kind of work?
Yes, sure. And thanks for inviting me, Alex. It's a pleasure to be here. So as you said, I run Systemiq Capital, which, can be easiest explained as a spin out from Systemiq. In turn, Systemiq was a spin out from McKinsey. So that's sort of been the progression, and all that happened in 6 years. Systemiq, which is the company I initially joined 4.5 years ago, was 30 people when I joined them. We were sort of stuck in a little startup WeWork space, and it's now grown to about 400 people globally. So Systemiq is by now the world's leading pure play climate advisory firm. And the name suggests that it is really all about system change, which lots of people understand in different ways, right? And it's not easy to explain, but what we understand, what we mean by system change, is that across the main pillars of the transition, which we sort of internally describe as energy, materials, and nature, right? Obviously, finance cross-cuts, but those are the three big ones in terms of real economy. You can't really get to a 1.5 degree world, if it's even possible by now, with marginal changes to, the so-called system 1.0. You really need to move to a system 2.0, which is often a radical rethink of how things work today. And to do that, you can't, work in the way that typically the world has always worked, right? Which is the investors talk to LPs and they invest in their own thing. And, and the policy guys, they sort of talk between them and, and they take best cases from around the world and move on. And the corporates, these working silos won't get us as far as we have to in the time limit, in the urgency that we have. So that's what we mean by system change, right? How we get to system 1.0 to 2.0 across these major pillars, and then we'll sort of go deeper in what we actually do. And how do we then work together with these sort of key constituents of the transition, right? The corporates, the policymakers, the investors, but also the NGOs who in the climate world, they are actually really important. And then the technological disruption, because it would be an illusion to imagine that, a lot of these systems will be the way they are in 2050, because there will be so much technological disruption. And that's where my bit, right? That's what I do in this whole ecosystem. But of the 400 people at Systemiq, there are people who specialize, right? Both in a sector, in a system, the way we call it internally, and in terms of constituents. You'll have the people that come from an NGO background, you'll have people that come from a policy background, you have people that come from finance, corporates, former consultants. And that's the whole point, working together so that we can move these constituents at the same pace. And to take it a step further, right, internally we say, on the consulting side, they say, but then we sort of join along, is the system is our client, right? Which really means if I want to get to, no packaging, no single plastic usage by 2050, for example, who are the key constituents I need to bring along? Who are the pioneers, the nodes who, if I shift them, given their stature, right, in that particular space, they're going to shift the sector faster. Sometimes it's a corporate, so they're going to advise them one-to-one, right? And they will typically work at high level with the CEOs and the boards. Sometimes it's an investor, right, where you say, well, actually, I want to help to shift billions into this space by explaining investors better how this space is investable. Policy often. And we then, by investing into early stage as a venture capital into early stage startups, we then plug the tech disruptors into this ecosystem, right? So as the tide moves, the our early stage founders are part of the tide, and they're part of a broader platform that they wouldn't have access to outside of Systemiq, right? So that's really the unique approach to system change that we take internally.
Okay. And then specifically your kind of world that you inhabit is this piece of fundraising and capital allocation to really help scale up relatively early stage tech. I say relatively, that's a bit of a guess, actually. Maybe you want to map that out a bit.
I'll map that further.
Yeah.
So, when you typically read, the various transformation roadmaps and stuff like that, they will typically look at technologies that are quite advanced, TRL, 7, 8, 9, right? Very advanced. The reality is that the things that are going to disrupt the economy in 10, 15, 20 years are those that are maybe now in 1, 2, 3, 4, 5, right? So that it's very important to look at what's going on in that space. So Systemiq Capital is a governance independent company, right? We sit in the Systemiq office, we have cross shareholding, we have, Systemiqers who are deeply involved in what we do, but fundamentally we are an independent company run separately. We've always raised external capital. It was never, Systemiq money that we invested. It has always been external capital. We are now at Fund 2. So we started when I joined, which was early 2018. And we're now at, sort of 4 years and then moved into Fund 2, which we closed, as I mentioned at the beginning last week. We invest in Series A companies. So when you look at a startup, they will typically have an idea. They will have a friends and family round. Then they will do a seed round, and they will do a Series A round, Series B, and then the letters go on, right? Until either you're sold or you IPO. And we do A, occasionally we do B, very occasionally we'll do seed. Why? When I joined Systemiq, it was a blank piece of paper. We could have chosen to do anything. We could have chosen to invest in funds, right? We could have chosen to do lots of, or non-profit, whatever. Systemiq had the luxury of having raised the money before we even knew what we were going to do. So when I joined, the money was there, but the strategy wasn't there. So we then sort of had to do that from scratch. And I think it became clear that where we add most value, first of all, it has to be direct, because you have to have that direct interaction with the founder or founders. And when you are at seed stage, you sort of have an idea. But if I help you to go and speak to the CEO of God knows what company, and you have nothing to sell them because it's still an idea, then I'm not going to be very helpful to you, right? Equally, Series A, B is when you have a minimum viable product, and then we can help you to commercialize it faster, right? To shorten the time it takes for these technologies to come to market. When you go beyond, Series C onwards, then it's a scale up. Those are different challenges, right? It's operational, how do I think about, becoming a 500 to 1,000 people company? Who are my key roles in the company? Again, that's not us anymore. Systemiq, there are individuals who know that stuff, but Systemiq as an institution is best placed in helping early stage commercialization, helping tell a better story, because when you are at an early stage, especially when you're going after hard stuff, who you tell the story and how you tell your impact story really matters, because it's also about inspiring people, right? That something is possible in a different way. And those are the things where we are most useful. And that's very much Series A/B.
Okay. And then when you think about this, all these hundreds of thousands of very early stage businesses that are, hungry for that kind of Series A investment, how are you segmenting them? Are there certain types of software, or is it hard tech, or is it certain types of issues that they're solving, or are you very much led by the team? Or tell us a bit about what's that kind of filter, the sieve that you put them through.
So we are very research driven. We're very top down. That's very much the DNA, right? Sort of following from everything I said before. So I mentioned before, Systemiq is organized into energy, materials, nature, right? And then finance that cross-cuts. Within each of those, they then look at multiple sectors. Energy, we've always been a lot about so-called hard to abate sectors, right? So shipping, on the transport side would be shipping, aviation, and trucking. And then on the industry side, it's chemicals, cement, steel, and aluminum, right? That's always been like a big focus for Systemiq. As a result, it's a big focus for us too. The food space and nature space has been always huge, right? From biodiversity to in carbon markets to regenerative agriculture, and then now going into sort of more cultured food, right? That's another big space for us. Then on the material side, it very much started with plastics and chemicals. And then sort of it merged together with the hard-to-abate materials, right? The sort of common space, and then mining became another big one, right? The sort of we started looking at. And then you can break it into another multiple subsectors, but that's where we start. Unless there is deep expertise, a team of 10 plus people who that's what they do year after year, we wouldn't even bother looking at that sector. Because again, as a small investment team, we don't want to be yet another VC, right, that puts a bet and hopes for the best. That's really not who we are, right? We want to be value add on everything we do. So we'll look at a sector. So the way we explain our narrative in Systemiq Capital, which is a little bit, less high level than at Systemiq. So we sort of say, so we invest in companies that look after new ways of producing sustainable food and materials. We then look at how people and goods are transported, how all this is financed, and how we deal with externalities, right? So these are the 4 blocks. So if I then take it a step deeper, right? Food and materials, that on the food side is regenerative agriculture, plant-based, cultured food, right? That's world. Materials is what the hard-to-abate, so chemicals, steel, cement, aluminum. Transport, hard-to-abate, shipping, trucking, aviation, but then also circularity, right? So there we have a whole team in Germany that they look after so-called circular mobility. How do you get rid of cars in cities? How do you, eventually make intermodal transport the way to go so people can really get rid of cars, which are some of the most inefficient asset uses in the world, right? And then free up cities for other things. On the how we finance things, it's very much data, right? So we would look at how do we find better SaaS models, data platforms that enable fundamentally better data so that the investors, corporates can make better decisions. And that's, from traceability, supply chain software, physical climate risk, transition climate risk, ESG sort of analytics for investors and that whole world. And on the externalities, we look at 2, which are very much about restoring the planet, right? One is the removal of CO2, not offsets. We don't really like, or, we can go separate into that space, but, I didn't mention, but before Systemiq, I spent 13 years at Goldman Sachs in commodities, where I was sort of deep in power, gas, and carbon. So I'm one of those dinosaurs who lived through the first day of phase 1 of the ETS scheme. And then went through that whole, a fraudish disaster of the CRs and the collapse back to zero. And that makes you skeptical forever, right, about those markets. And there's lots of similarities today to what happened 12 years ago. But we do look at removals a lot, especially when it's about utilization of CO2 and methane. We love methane, hard to invest, but it's a massive, it's a massive problem. And I wish there were more companies that are going after that. So removals, and the second bit is biodiversity. How do we restore biodiversity, which today is still a lot, a mix between data, better data, leveraging, the sort of genomics and satellite progressions that we've done in tech. But also, I guess we believe a lot that the conservation of nature fundamentally will be not because of, some pseudocarbon from trees, but because of the inherent richness that nature has, which is then you can reduce it to the smaller microorganisms, right? And the fact that, these enzymes that are in nature can then be used to make the food, the chemicals, and the farm of the future. So I think, you got it that from this last based on biodiversity and food and chemicals at the beginning, we actually do a lot of biotech. And that's maybe what sets us apart from the typical climate tech funds. We do nothing about primary energy, right? Anything to do with power generation, heat, right? This kind of energy efficiency, right? That's out of scope. There's plenty of people that do that, and this is not what Systemiq is famous for, right? And that's not really the edge. But we do believe that we are, I always like somebody, I'm not sure who said that, it's certainly not my invention, but, the 19th century was the century of chemistry, right? The 20th century was the century of physics. This is the century of biology, right? When I went to school, we learned that nature is random. And guess what? It's not random anymore, because we are, and it's amazing how, there was the CRISPR invention last year, the AlphaFold, right? Every year the technology is advancing so fast. And this is going to have huge implications on climate, right? And you add on that, the third generation computing, once we get the quantum computer and others, because there's others, essentially you're going to be able to do in a biological way processes that until now have had to be done based on fossils. Right. And that's a space we very much believe in. And we've done plenty of investments in that space as well. So we are a team of 6 on the investment side, and 2 are biologists. That's just to share, just to sort of explain how much we believe in that space.
Yeah, just how significant it's going to be in the sort of solutions drive. And just a little more background on the fund and allocation. So you mentioned you've just closed your second fund. Just give us a sense of the scale of those, and also what's the average investment you're making in these Series A?
So on Friday, we executed the first closing. When you close a fund, it goes into multiple closing. And the first is always the biggest pain in the neck. So Friday, we closed the first 70 million. And we'll do another closing of about 50 after the summer. So it will be a 200 million fund.
And then if I'm one of your targets, what kind of range are you typically?
So it varies really, right? We can go as low as 1 million and we can go as high as 10 for the first investment. And then we'll follow, right? Obviously, we'll not follow everyone, but for the companies we have conviction, we'll follow for 1 or 2 rounds.
Okay. All right. Well, let's kick up a gear and have a look at something that came up during our prep call. So when we were talking about the way you look at the world and the way you look at investments, one of the things that you mentioned that I thought was interesting, because only one other person has talked to me about this, was the fact that you were really pointing out that better data is needed throughout the supply chain, and this is in ESG terms. So I wondered if you could just sort of map that out a little bit. Like, what kind of data deficiencies are you seeing, and what's the problem with that? What is that kind of then maybe leading to?
Absolutely. So, let's start maybe from what ESG data today is, right? If you are a large pension fund and you have an ESG fund, you will be dealing with the same data, the core data that from corporates is going to be the same ones as everybody else has. There's a whole industry of ESG data providers, but fundamentally, they all get their data from something called CDP, the Carbon Disclosure Program, which was established, I think it's now must be 15 years ago, right? Which is a non-profit where corporates report to, and then sort of they make it public. So you fundamentally deal with data once you see it about the company that is about emissions, that and operations that happen at least a year before, sometimes more, right? So it's really outdated. Now we've obviously done lots of progress in the last 3, 4, 5 years, where that so-called unstructured data is being layered on top, right? And that's where the whole industry coming on top, where they're going to add satellite data and weather data or data about congestion, whatever is relevant for that particular supply chain, so that it's overlaid with that with that sort of backward-looking data. But it's still very early days, right? The typical company, even if you are a large multinational company, you will know. For your supply chains, right? You will know maybe two nodes behind you where stuff is sourced from. But largely, you will have no idea who sits on your supply chains before. And again, there's lots of companies that deal with that. Right? Some are unicorns by now, but they all rely on voluntary. They will go into a data system and they will look at invoices and stuff, right? Which only gets you as far, right? So there's this huge need to actually get more real-time data, and second, more granular supply chain data. The first one is so that I can accurately see what's going on and I can accurately make investment decisions, not based on what happened a year ago. And the second is because of scope 3, right? The vast majority of companies have, the vast majority of their emissions on scope 3. And many of them have no idea what those really are, right? So it's an estimation. And then again, what is my scope 3 is somebody else's scope 1 or 2, right? So that you go into this issue of massive double counting as well. And in the last 24 months, I guess, there's been a big explosion in climate tech, of companies that go after so-called carbon accounting. Right, there is the Watershed, the Persephone, Normative, right, and many others. Those three may be the most successful. But again, they typically look at invoices. So it's amazing, right? The fact that we have these technologies that did not exist 5 years ago, but it's not the end of the journey, right? We have to push further and further. And then that's something that makes climate tech software, I think, harder to invest, right? Because a lot of time VCs will say, oh, CapEx heavy, I'm not going to take a look because it's never going to make returns, right? And it's not necessarily always true. I actually think that the biggest fund returners in climate have an element of CapEx intensive, because those will have an enormous, we talk about TAM, total available market, right? Often software in climate is vertical, and it's often in a space where they then have to create a market that doesn't exist yet, right? Physical climate risk, it didn't exist until 6 years ago. And because it's vertical, right, it's harder in climate to imagine that you're going to have, these 50 billion climate tech companies and software, because they typically look at verticals. And so our fund 1 and fund 2 will be the same. We're about 60, 70 CapEx light, and 30, 40 CapEx heavy, right? If you sort of want to make it's a very simplistic approximation. And in fund 1, we invested in companies like Zeravia or Charm or Brimstone, who are definitely CapEx heavy. But then we also have companies that are very asset light, right? And sort of based on analytics such as Jupiter or Circular, TRC and things like that, right? So it's sort of, we do believe that from a portfolio allocation perspective, you need to have both, right? If you're a genuine climate tech investor, you can't stay away from CapEx, right? We're not going to get to 1.5 degrees with software. There has to be some real stuff out there, right, that shifts the needle. But at the same time, software is incredibly important because the data out there is incredibly poor.
So what's the shift? Like, what is it that you want to see? If that's where we are now, that we're in a sort of slightly kind of early stage mad phase of approximations and, age data informing investment decisions, what are the kind of next steps?
I think the end goal is that, if you are, if you're a trader, you see your risk real time, right? I mean, if you're a portfolio manager and you trade listed equity, you see your mark to market all the time, right? You want to move to a space where, this is obviously very idealistic, but as much as possible, you want to move to a space where the CO2 is also, right? And if a company decides that, now with the whole Ukraine crisis, obviously next winter, they're going to open every single coal boiler that can possibly be run in Europe. It's going to be switched on. But the investors are only going to see the CO2 results a year after when they disclose to the CDP, right? And in the meantime, they each does their own approximations or, some, right? So then you have to you have to employ these scores of analysts who do these calculations because there's not a system that gets you closer to real time.
So it's, what we need then is, ideally, you need to find a Series A level company that you can invest in that's going to kind of get us over this.
Yeah, but that won't happen. I wish, but that won't happen, right? Because the reality is that it's such a complex system. You'll have people that excel in different pockets of the system, and then eventually somebody's going to merge them, right? And I think it's still questioned, unanswered, whether that something is going to be a nonprofit like CDP or it's going to be, a Bloomberg. Right? I think the batch is still out there, which of the two. But in the meantime, there is enormous opportunities to invest in those who are going to be the winners in their own space, right? This is a space that until very recently was dominated by McKinsey, PwC, right? These kind of people who charge you a fortune, right, to calculate something. So the first phase is to get rid of those and digitalize and make it cheaper and faster. And then along the way, get better data, but better insights, and then eventually you're going to have consolidation.
So for you, though, as this kind of investor in early stage tech, right now, what difference is it making to you? Is it about the companies you invest in, or is it about the opportunity and kind of valuing the opportunity that they see? Where does that mismatch in data kind of affect you most?
So when you look at an early stage company, so we start from a top-down approach, right? So there's really two questions that you have to answer in our case, first of all, before you go into anything else, which is this an exceptional founder, right? Because that's the first. You can have an amazing idea, but it's all about execution in the end of the day, right? And there's plenty of people who have great ideas, but there's very few people that can execute. And so you need an executor, a closer, you need those. But you also need something that creates massive impact, right? Where we take a top-down approach. Many climate tech VCs will then make up a story around the founder, right? We're very research driven, so we will top-down. And then once you answer this question, then you start asking, is this a total available market that is going to be huge, right? Or is this, even in my best scenario, right, this is a market that's going to be worth $1 billion in 10 years, in which case you're not going to touch it, right? Because then the revenue pool available is too small. And then and then you can go into your property diligence, right? But that's what you always answer first. And in the data, I think it fundamentally comes down to, is there any proprietary thing that they have that nobody else has, right? Is the barrier to entry high so that, if it's a smart idea, then, next year the founder doesn't have 20 others who are doing the same, because it's such the moat, in VC, we call it the moat. You want the moat to be deep enough.
Okay. So yeah, I think how this has come up in other conversations before was in two different, I think this is all part of the same issue, but I know on a previous podcast, we had someone talking about that actually, because the kind of supply chain, the deeper supply chain is sort of so opaque and you can't really get accurate data from it, that even investments in those companies is hard to understand the ESG scoring of those companies, because everything that they rely on, everything that they are buying. I think that was the one time it had come up in the podcast, that was the content.
I mean, if you look at the ESG rankings, they are all over the place, right? But no large investor today is going to rely on somebody else's ranking. They do it in-house, right? And then because they do it in-house, so I think we are past the issue of which rankings are better, because they all have the same problems. But the real sort of the big money pools are looking at the data themselves, right? And that's where you have so much confusion. And I think a real, and again, you might have some amazing companies that have created a new source of data that is proprietary, but then it is so narrow that they then go to a pension fund. They're like, oh, I can look at 10 companies. And like, well, come back when you've got 1,000.
Okay, well, let's make a bit of a shift, because we are in a moment going to look at two specific investments that you've made, Brimstone and Charm. But before we do that, you mentioned earlier that you had come from this kind of old school energy finance background, 13 years at Goldman Sachs in the power finance division. So we are in the middle of this early phase of massive change, massive energy transition. How has that time and experience influenced what you do? Well, I guess how you look at what you do now. You mentioned something about there's a correlation between what those markets were doing 13 years ago and maybe what we're seeing in the offset world now. But what else do you think you're drawing upon from that experience?
I think the fact that I come from a background of real assets, right, where I spent many, many years and, touring power plants and looking at gas boilers and visiting oil refineries and LNG terminals and going on ships or looking at coal, I'm not scared of real assets, right? That's the world kind of I come from. And I fully understand its complexities, and I fully understand, how difficult, especially, the so-called first of a kind, right? We VCs, we can help with the first pilot or first couple of pilots. And then the commercial bay, Goldman is obviously at the very end of the queue, but there are some people who are slightly more, risk acceptant, who will go and look at, your third, fourth, fifth power plant. But you have those 1, 2 first commercial plants, we call them first of a kind, that nobody wants to touch, right? And if you are in the US, then there's some, especially now with Biden, there's some amazing policies, right? And the sort of the loan program, and you can really go really far with the government support. In Europe, not much, right? Historically in Europe, you depended on some corporate who, for whatever reason, decided that they were going to back this particular plant, right? But then typically they would they would create misery on your cap table, right? Because I mean, there's a price to pay for that, right? So that's certainly a space where you have to be very, very cautious, right? Which is maybe a reason why we have never financed the hardware, a heavy capex company in Europe, where maybe, with Fund 2 now, one of the first 2 investments will be in that space. It's going to be in sort of in the more food space, which is capex heavy. But there's a reason the companies in the UK, I would be a lot more wary if they were in Europe, because the regulatory setup in Europe is so much more behind on that particular sort of food space. I think it's a big loss, right? Honestly, because you look at how the whole US, Canada is similar, right? The whole ecosystem is created to help startups get up, right? You need 50 million, in the 100 million, we'll get there, right? I mean, even Tesla, they got like 300 million from the US government, right? To get where they got to at the beginning. Whereas in Europe, this Horizon, this kind of funding programs, right, are typically all geared around very large corporates. Right. So if you are a startup and you need, your first 50 million, you've done your pilot, I need my first 50 to 100 million for my first commercial plant. Good luck. Right. In Europe, it's really hard because VC won't touch you by then. I mean, why should I use equity for a bunch of steel that is going to be useless by the time you come to your second plant, right? Because you're still learning. I want the IP, I don't want the steel. Right. And so who's going to come, right? Your commercial banks won't touch it either because it's technological and proven, and you're stuck. Right. So that's often that's unfortunately the state of a lot of European technologies, right? And some have gone through, right? Especially in the battery space, Northvolt, right? There are examples that have been successful. But I'm afraid the graveyard is like enormous, right?
So that 13 years of power finance experience kind of brings you a strong, I guess it gives you a strong risk lens, but maybe also that grip on widgety, challenging, dirty industries.
Yeah, and what it takes, what it takes to build these like massive pieces of infrastructure, right? And how you go along the path, right? From VC all the way down to, one day if you will have like billions of infrastructure, it's a path. It's a path that historically has always taken 15 plus years, right? And of course, given the urgency we have, hopefully it's going to go to 10 or below, right? But it's not, when you invest in companies like, Brimstone, or, I mean, Charm is a little bit different, but Brimstone, Euravia, it's a 10-year journey, right? And as a VC investor, you have to be very cautious of that, right? Not think that you're going to have a way out in 3 years.
Well, that's a good segue into those two. So why don't we take Brimstone first? Tell us a little bit about why that company, why was it the right choice specifically for Systemiq Capital? Yeah. And where's it at the moment?
So Brimstone is a company based in technically, they came out of Caltech. So they are in California, though the founders are located in different places of the US. We have been looking at the cement and concrete space for a very long time. And I think if you take a top-down approach, you can start with energy efficiency models, right? So how do you use less energy, but also how do you move to a lower clinker cement so that the CO2 goes down? Then you have all those models of removing CO2 in the curing process, right? The carbon build, the carbon cures of the world. Then you have a carbon capture, which we don't believe in, but fine, right? It's out there as a path. And then you have the new ways of making cement, right? So these are the 4 pathways. So I already said the third we don't believe in, so out. The curing one, we spend quite a lot of time looking at that. I have huge doubts on that. Again, I'm looking at impact, right? Because it's in the category of marginally nice, but it's not going to turn the needle. The first is very important, like efficiency, especially those are lower capex models, right? And again, Europe is going to go towards lower clinker, so that's a space we like a lot. And then in the space of novel cements, you have a whole spectrum again, right? Why Brimstone? First of all, is like amazing, astonishing founders, right? They are fantastic, right? And that, as I said before, it's the most important thing. Then their what they produce, and I can explain a little bit more how they do it, but what they produce is chemically identical to Portland cement. And that's huge, because typically many other things we looked at do not, right? Which means that then to commercialize that, you don't need like a whole new planning, regulatory approval, right? You can go straight in. But, Brimstone starts from a different premise, right? So cement today is produced, you have limestone, which is put into a kiln, and then sort of the CO2 comes out. You have concrete. Sorry, you have cement, and then cement is then added into the concrete together with aggregates and sand, right? So cement is usually about a third. And cement is the one that is CO2 intensive, so you want to bring cement down. They start not from limestone. They start from silicate rocks, which are the most frequent rocks in nature, and they have no CO2. Right, so you've already emitted, you already sort of removed that sort of CO2 from the kiln process. So when you treat the silicate rocks in the Brimstone way, then there's three things that come out. Is you have this chemically identical Portland cement, which can go straight into the construction industry, into concrete. You have another byproduct, which is identical to fly ash, right? And fly ash is another big problem in concrete, because with closing down coal plants, we have less and less of it. And so they then try to replace it with things like slag. But that's another problem, because we are closing down steel plants too, right? So that's a space where people have been spending a lot of time on. And so they produce that as a byproduct, so you don't have to ship it from anywhere, it's there. And then the third one is also interesting, which is a magnesium oxide, which they could then sell to, the Rio Tintos of the world, who could then sort of sprinkle it on their mining tilings, and that would sort of remove CO2. That's a mineralization process.
So it's partly, yes, you can see in there that it's the actual core product is clearly of interest. And as you say, we actually will be having an episode soon with a really interesting disruptor that is going down the path of a replacement for cement that would require, that kind of regulatory change to allow for the use of it, whereas this doesn't. So that's amazing.
Exactly. And we really looked at so many businesses, and these guys really sort of stand above. Is it risky? Yes. Very risky. Yes. Right. They raised, I think they raised a 65 million Series A. So it was one of the bigger Series A's towards the end of last year. They have Breakthrough Energy Ventures, which is a fantastic investor in North America, right? Who really sort of goes, I think, they don't say it in the way we explain it, but they go after system change, and they work in a similar way than us, right? Obviously on a much bigger scale, but they also have sort of the policy angle, the corporate angle, and all that. So yeah, look, the Series A was closed in, I think it was November or December. Actually, no, it's this last period has all merged in my mind. It was this year, it was in Q1. And now they will build the first pilot, and we would hope that by 24, 25, this is something that can be commercialized in the market. In the climate tech Bible of disasters, the one that is most prominent is Solidia in this space. And I think it has really been a learning lesson, right? Cement is also a place where it's an oligopoly. And so that's the additional complexity compared to other sectors. It's an oligopoly that we don't believe that it's been attacked on all fronts, also because, they're so-called poor cousins, the concrete people. Maybe the balance of power is going to move a little bit, because cement is the one that is really problematic from a CO2 perspective, not concrete, right? And so it will be interesting, right? Again, this whole Ukraine situation, I think it's going to delay many of the ETS provisions a little bit, but it's going to happen eventually, right? And cement will become part of the ETS. Today it's not, or it's only partially. And the moment when you have to buy all your emissions, given that the ratio is 1-to-1, then it's going to be a big problem, right? And if your decarbonization is better than your neighbors, it's going to be a huge value add or value detractor, right? So we do think that, the cement sector is one of the most ripe for change out there.
And then Charm, how does that sort of compare? What's sort of similar and different in their story?
Completely different sector. So Charm is started off in the removal space, but it's actually a steel decarbonization technology as well, right? Which we like a lot. As I said before, we're not the most excited about companies that are just about, removing carbon and selling these credits to somebody, because in the long run, you never know where that's going to go. So Charm, you're familiar with pyrolysis, it's been around for 30 years. And typically, if you have a pyrolysis plant that is fed on biomass somewhere, in the middle of an agricultural country, when the harvest isn't there, you have an issue. Where's the feedstock going to come from? And so typically those plants are kind of at the mercy of it's like a seller's market, right? The sellers will dictate whatever the price is. And so I think where Charm changed that is, they sort of flipped the issue on its head. So it's a business innovation rather than a technology innovation. They put this pyrolysis on trucks, and the trucks go to where the biomass is. So you can almost picture, in the US, they have a whole industry where farmers rent these huge tractors during the harvest season, and then the tractors go to wherever the harvest is of a particular crop, right? So this is similar. You have these trucks that go, sometimes it's, the forest of California, where they have like all this sort of untreated biomass on the surface that then creates the fires. Sometimes it's some kind of corn harvest or what it might be, right? So they travel around. And then the modular mobile pyrolysis units produce a very sticky bio-oil, which the initial business model was to inject into unused reserves of oil and gas in the ground as a form of permanent removal, which then they would sell to the the Shopifys of the world. But they're now in discussions about using that bio-oil as an input to make syngas. And that syngas can then become an input into the DRI, right? The direct reduction process in steel, so that it's a replacement of fossil natural gas. And that's a very interesting space, right? Because in the steel industry, there's this mantra that, it's got to be hydrogen, right? And I'm really observing that it's like a monolithic kind of, single way ticket to hydrogen. That's our path. But the reality is that if you are, it depends where you are, but if you're steel plant, it's in a part of the world where there's a ton of available biomass. And if you go very close to the biomass, to the field, right, you might get it for free, because otherwise the farmers will have to pay to get rid of it, right? It might actually be an incredible, locally, right, an incredible, interesting path to steel decarbonization, right? And that's very much what Charm is doing, which of course in North America is incredibly interesting, but equally in parts of Europe, you have a lot of sort of this biomass availability. So that's, again, it follows the same trick as Brimstone, exceptional founder. And I think our founders, all of them, that's what, they wake up in the morning because this is their contribution to climate, right? It's not some funky thing where, they've been doing something for 10 years and all of a sudden it's cool to paint it green, right? It's kind of the opposite of that. They are mission oriented in a way, right? If you want to call it like that. And that really matters, because when you are at an early stage, you'll have to pivot many times before you come to success. And if what drives you fundamentally is not the same North Star that we have, eventually you might end up doing stuff that is problematic, right? I'll give you an example. DAC. We don't really invest in direct air capture. I think it's the energy usage of that, it's insane. And we are many years away from this being something that the world can scale. But the only single use, large scale use for DAC today, it's the injection for oil, EOR, enhanced oil recovery. That's a problem, right? I cannot invest in a company as a climate tech investor that then uses that technology to suck more oil out of the ground. So you have to be careful again, it's a system. Things things link to each other, right? And the more you understand the complexity, climate tech is not like a cool social media thing that you just come in and out, right? Everything is interconnected, and you really have to understand how things fit one with another, so you avoid these kind of issues, and hopefully you make superior returns because you understand, the complexity is better than others.
Well, that kind of leads me quite neatly then into my kind of final main question, if you like, which is you've talked about these two examples of investments you've made. You've talked about perhaps this sense that for some people investing in climate tech, it's just another asset class. It's not something where they're looking system-wide. They're just looking at the specifics of a given company. And I'm wondering, if we come into this final question, whether that is maybe one of the blockers that you're seeing to the industrial emission tech system really gaining the scale that it needs, and if not that, then what? So maybe if I clarify that question, what are the blockers or bottlenecks that you're seeing? What worries you at the moment? There's clearly rafts of opportunities out there, so many companies that you have positive, intent and interest in, but there must be some concern about sort of the potential blockers or things that could slow down the transition. What do you think they are right now?
Do you know what is my biggest worry? My biggest worry is that within climate, there are lots of sectors that are in bubble territory. And my worry is that some of these bubbles get big enough so that we go back to, the cold years of 2010, 2015, 16, where so much money was lost that the asset class on its own became uninvestable, right? That's my worry, that there's too much money that goes into the wrong places. They lost, right? I think it's so different, right? If you look at climate tech 1.0 in, I guess the burst happening after the financial crisis, it was really all about fuel cells and alternative solar panels, right? That's really what it was. So it was nowhere near as diverse as it is now. So we are much more diversified now. But there are some bubbles that are very significant, right? And again, there is way more money now than there was back then. Look, capital chooses to invest in the things that they want, right? I'm not going to name the bubbles, but I can think about 3 or 4 very distinct bubbles where you get to a stage where you don't understand why investors are putting money they are, the valuations that they are. So all I can do is stay out of those, hoping that when the bubble bursts, it's not going to have an impact on the sector as a whole, right? Because really the last thing the world needs is that we go into another cold winter where, you don't touch that because, it doesn't make money. That's the last thing the world needs.
Well, then with that in mind, I'll ask you to give maybe a closing comment or call to action, if you like. So if imagine you've got a, sparky disruptor tech founder listening to this, and you've also got, someone that's worked their career through one of the harder to abate sectors, but is also committed to decarbonisation. Like, what's your call to action to those two groups, or what's the comment that you would make to them?
For the first one is to be very realistic, right? As a founder, unfortunately, it's a very small subsegment of founders who VCs will fund, right? I think a very good example is there's lots of people, we chat, it's an expression again, right? We sell jet kerosene. You might be very happy to go with petrol, right? It's a choice. VCs will push you to the things that you don't have to, right? So that's the first. And if you are a founder, you have to be very cautious about which choice you do, right? Because there's a particular person that can take the jet kerosene and not the other, right? Because it comes with particular amounts of stress. For the industry, look, if you are part of a large corporate, in the end of the day, you are, you can't necessarily decide your destiny, right? You're part of an administration, and then you do, so of course you have to push the boundary as far as, as much as you possibly can. But I think, one of our companies, Cool Planet, used to struggle with, these sort of engineers in the boiler rooms who wouldn't wouldn't care about, following their indications about energy efficiency. And then they would organize a fair at the weekend where they'll come, with their husband, with their wives or husbands and children, and tell them, this is your contribution to climate change. This is what you can do. It's a pain in the neck, but this is what you can do, right? So I think, again, we all somehow, revert to the idea that, oh, the state will do it. Somebody above me will do it, right? But often these are decisions that are down to each of us, right? And it's not dissimilar if you are in a big corporate where, if for the sake of climate, you have to do something really painful, but maybe it's worth doing, right? Because that's your contribution.
Yeah, well, I think that's a great note to end on. Thank you so much for giving me your time, Irena. I mean, really feel it's been a really interesting conversation, and I definitely look forward to hearing more from Brimstone and Charm, brackets, maybe getting them on the podcast. But thanks for talking us through, your perspective and your view on this world.
Pleasure. Thank you much for having me again.
Many thanks for listening to the Decarb Connect podcast. We work with clients across the industrial sectors, specifically those who are tasked with decarbonising the most energy-intensive products and materials that we use every day. If you have an interest in learning more about either our members network, our reports, or our event series, do get in touch with us at decarbconnect.com. Or if you'd like to take part in the podcast, email me, Alex, at ac@decarbconnect.com. Thanks for listening.